What if the entire financial system is being held together by a lie so obvious that nobody wants to say it out loud? I'm talking about gold and silver. The stuff we're told is just a relic from a bygone era. The thing boomers hoard and conspiracy theorists obsess over. Except, here's what nobody's mentioning. Central banks around the world have been panic buying it, like there's a fire sale. We're talking over 1,000 tons per year for the last 3 years straight. China, India, Turkey, Poland, they're all loading up. And they're not doing it because they think it looks pretty in a vault. So let me walk you through what's actually happening. Because the story you're getting from CNBC or Bloomberg, that's the sanitized version. The one where everything makes sense and the adults are in charge. The real story is messier, and it starts with a simple question. Why is gold trading above $2,500 an ounce when interest rates are supposed to make it worthless? Here's the textbook answer. Gold pays no interest. You hold it, you get nothing. Meanwhile, you can park your money in a Treasury bill and collect 5% risk-free. So gold should be getting destroyed right now. That's what every Finance 101 class tells you. Opportunity cost, basic stuff. Except gold isn't getting destroyed. It hit record highs in 2024. It's still sitting comfortably above 2,500 as we speak. And that's not a fluke. That's a signal that something fundamental has broken. I spent 2 days digging through World Gold Council data, cross-referencing it with Treasury debt reports, and what I found was a pattern that suggests we're not in a normal market cycle anymore. We've entered what analysts are calling a fiscal dominance regime. And if you don't know what that means, buckle up, because it's the key to understanding everything. Fiscal dominance is when a government's debt gets so massive that the central bank can't actually control monetary policy anymore. They're trapped. They can't raise rates high enough to fight inflation without bankrupting the government. Think about it. The US is now spending over $1 trillion per year just on interest payments. That's more than the entire defense budget, more than we spend on Medicare. It's the fastest growing line item in the federal budget, and it's only going one direction. So what happens when the market figures this out? When traders realize the Fed can't actually do what it says it's going to do? They start looking for exits. They start buying things that don't have counterparty risk. Things that can't be inflated away or sanctioned or frozen by a government decree. Things like gold. Now here's where it gets interesting. Because this isn't just about the US. This is global. In 2022, the West froze Russia's foreign exchange reserves. Think about that for a second. We essentially told the world, hey, if we don't like you, we can just take your money. Doesn't matter if you play by the rules. Doesn't matter if you bought our bonds in good faith. We can turn off the tap whenever we want. And the rest of the world watched that happen and thought, okay, noted. That's when the gold buying spree started. Not in 2008, during the financial crisis. Not during COVID, right after the sanctions. Central banks realized that holding dollars isn't actually safe if those dollars can be weaponized. So they started quietly, and then not so quietly, diversifying into the only asset that can't be seized remotely. But here's the part they aren't telling you. A lot of this buying isn't even being reported. China, for example, stopped publishing accurate gold reserve updates years ago. We get numbers from the People's Bank of China, sure, but nobody believes them. Independent analysts think the real number could be 2 or 3 times higher. There are literal black holes in the data. Gold is moving, prices are spiking, and we can't see who's buying. That creates volatility, massive volatility, because when you don't know where the demand is coming from, you can't price the asset properly. And when you layer on top of that the fact that 60 to 70% of daily trading volume is driven by algorithms, by high-frequency trading bots that react to data in milliseconds, you get this environment where gold can swing 3% in a single day on a CPI print. Let me explain how these bots work. They're programmed to trade based on real yields. Real yields go up, dump gold. Real yields go down, buy gold. It's mechanical, It's instant, and it creates these wild oscillations that have nothing to do with fundamentals. A jobs report comes in hot, bots sell. It comes in cold, bots buy. Rinse and repeat. The humans are just along for the ride. Now let's talk about silver, because silver is where things get truly insane. Silver isn't just a monetary metal, it's also industrial. It's in solar panels, it's in electric vehicles, it's in electronics, and here's the kicker. The silver market has been in a structural deficit for 5 years straight. Supply is falling, demand is rising. We're talking about a 200 million ounce shortfall in 2024 alone, according to the Silver Institute. Do you know what happens when you have a commodity in deficit for 5 years? Normally, prices skyrocket and new supply comes online. Except it's not happening. Why? Because silver mining is brutally expensive. You don't just dig a hole and pull out silver. It's usually a byproduct of other metals, copper, zinc, lead. So even when silver prices go up, miners aren't rushing to build new mines. It takes years, it takes billions in capital, and by the time they break ground, the price might have crashed again. Meanwhile, industrial users, solar companies, EV manufacturers are panicking. They need silver. They can't wait. So they're hedging. They're locking in prices. And that's putting even more pressure on a market that's already stretched thin. Here's where it gets wild. The physical silver market is tiny. I mean microscopic. There's maybe a few 100 million ounces sitting in COMEX warehouses. But the paper market, the futures market, that's trading at a ratio of over 100 to 1. For every ounce of real silver, there are 100 paper claims on it. Think about that. It's like a bank that has $1 in the vault, but has written 100 checks. As long as nobody asks for their money back, the system works fine. But the second someone tries to take delivery, the second someone says, "I don't want your paper, I want the metal," the whole thing seizes up. Prices spike, shorts get liquidated. Chaos. And it's happened. Multiple times. In 2021, the Wall Street Bets crowd figured this out and tried to squeeze silver. It didn't work, but it rattled the market. More recently, there have been whispers of large entities, maybe sovereign wealth funds, maybe central banks, quietly taking physical delivery. We don't know who, we don't know how much, but the price action suggests something's moving under the surface. Now let me steelman the opposing view for a second, because there are smart people who think this is all nonsense. Goldman Sachs, for example, will tell you that gold is just a speculative asset with zero cash flow. They'll say, "Look, you can get 5% on a T-bill, why would you hold gold?" And they have a point. From a pure opportunity cost perspective, gold looks expensive right now. There's also the Bitcoin argument. The idea that younger generations don't care about gold. They see Bitcoin as the new scarcity asset, digital gold. And if that's true, maybe gold's best days are behind it. Maybe it's just a boomer trade. And on the supply side, some analysts think higher prices will eventually bring new production online, that the silver deficit will fix itself, prices will crash, and everyone who loaded up on physical metal will look like idiots. These are real arguments. I'm not dismissing them. But here's what they miss. The opportunity cost argument assumes that Treasury bills are actually risk-free. And maybe they are in nominal terms. But in real terms, after inflation, after you account for the fact that the government is printing money to pay its interest bill, that's a different story. Gold isn't competing with T-bills. It's competing with the dollar itself. And the dollar is being debased in real time. The Bitcoin argument is more interesting. But Bitcoin has a problem. It's not adopted by central banks. It's not accepted as collateral. It's not part of the global reserve system. Maybe that changes. Maybe in 20 years, Bitcoin replaces gold. But right now, when push comes to shove, central banks buy gold, not Bitcoin. That tells you something. And the supply response argument? Sure, maybe new silver production comes online. in 5 years, in 10 years. But what happens between now and then? What happens when industrial demand keeps growing and the deficit keeps widening? You get price spikes, you get chaos, and you get opportunities for anyone paying attention. So here's where we are. We're in a market that no longer follows the old rules. Gold and silver aren't reacting to the Fed anymore. They're reacting to a deeper structural loss of confidence in the fiat system. Central banks know this. They're buying. Retail investors are starting to figure it out. They're buying. And the paper market, the futures market, the ETFs, the algorithmic trading, that's the last place where the old paradigm still exists, where prices are still determined by 10-year yield spreads and CPI prints. But that disconnect can't last forever. At some point, the physical market and the paper market are going to converge. And when they do, the repricing is going to be violent. I'm not saying go buy gold coins tomorrow. I'm not selling you anything. But I am saying this. If you're watching the financial system and thinking everything seems fine, you're not looking closely enough. The debt is unsustainable. The central banks are trapped. The global reserve system is fracturing. And the only assets with zero counterparty risk are the ones that have been around for 5,000 years. So what happens next? Honestly, I don't know. Nobody does. But here's my guess. We're heading into a world where volatility is the default, where every data print, every geopolitical flare-up, every debt ceiling fight triggers massive swings in gold and silver, where the line between safe haven and speculative bubble gets so blurry that nobody knows which side they're on anymore. And here's the question I'll leave you with. If central banks don't trust the dollar enough to hold it exclusively,